The S&P 500 just posted one of its strongest months in nearly 6 years. Yet, almost the entire rally is being driven by a handful of AI stocks. Sound familiar? In 1999, the dot-com bubble looked exactly the same. Until it didn't. Today, we're comparing the two bubbles side by side with the actual 2026 numbers. For those who weren't investing back then, the dot-com bubble peaked in March 2000. The Nasdaq soared on internet hype, with many companies trading at hundreds of times earnings, even though most had zero profits. When it burst, the Nasdaq crashed 78% over the next 2.5 years. Trillions in market value evaporated. Companies like Pets.com and Webvan went to zero. But here's the key. The internet itself didn't disappear. It just took a decade to mature. Fast forward to 2026. Valuations. Nvidia is currently trading at around 42 times trailing earnings. High, though not as extreme as Cisco's 200 times at the dot-com peak. The Shiller CAPE ratio for the whole market is now near 40, very close to the 44 level seen right before the 2000 crash. Hype and AI washing are rampant. Just like every company added .com in 1999, dozens of unrelated firms are now stuffing AI into earnings calls, driving 20 to 30% stock pops on headlines alone. Investor sentiment is pure FOMO, record trading volume and extreme concentration in a few AI names. But 2026 is not 2000. Unlike the dot-com era, where only about 7% of companies were profitable, today's AI leaders are generating serious cash. Nvidia alone reported over $120 billion in net income for fiscal 2026. The big 7 tech companies produced roughly $350 billion in free cash flow last year. The technology actually works and is being adopted right now by businesses and consumers. We also have far better transparency. Real-time data, detailed earnings calls, and social media mean investors aren't flying as blind as they were in 1999. And regulators, plus central banks, have more tools today to manage the fallout. So how do you decide if the market is too hot right now? Use 3 quick checks. 1. Is the company generating real revenue and profits today, or just hype? 2. What's the PEG ratio? Price divided by earnings divided by expected growth. Below 1 is usually reasonable for fast growers. 3. Are you seeing actual customer adoption, or just press releases? And here's the practical playbook. Use dollar-cost averaging instead of lump sum bets on single AI stocks. Diversify. Broad index ETFs or the proven leaders, Nvidia, Microsoft, Google, Meta, are safer than chasing the next small AI name. Avoid leverage and keep some cash or non-AI sectors, energy, utilities, value stocks, on the side. History shows money rotates when sentiment flips. The AI boom has real foundations the dot-com era never had. But the valuations and hype level are flashing the same warning signs we saw in 1999. Ray Dalio, in Principles for Dealing with the Changing World Order, reminds us that big technological shifts often create bubbles. Yet, the underlying innovation can still reshape the world for decades. The next 10 times winners will go to those who stay disciplined. If this data-driven comparison helped you see the market more clearly, hit like and subscribe. Drop bubble in the comments. I read every one. And tell me, are you still all in on AI stocks right now, or playing it more cautious? I will see you in the next one.